A sound internal control system is an essential element of corporate governance and enterprise risk management, providing the organizational framework through which risks are identified, managed, monitored, and reported while supporting the achievement of strategic objectives. Modern organizations operate in increasingly complex environments characterized by technological disruption, cyber threats, regulatory change, and global operational risks. Consequently, internal control systems must extend beyond traditional financial controls to encompass operational, strategic, compliance, and information risks. Within the program, internal control is regarded as a continuous management process embedded throughout organizational activities rather than a separate compliance exercise. Effective control systems support organizational resilience by safeguarding assets, promoting accountability, reducing uncertainty, and ensuring that strategic objectives can be achieved within acceptable levels of risk. A robust internal control framework therefore contributes directly to sustainable value creation through improved governance, operational efficiency, and stakeholder confidence. The framework identifies several characteristics of a sound control system. First, internal control should be embedded within normal organizational operations rather than treated as a separate exercise. Control procedures should form part of routine business processes, ensuring that risk management becomes an integral component of operational decision-making instead of an isolated compliance function. Embedding controls throughout organizational activities promotes greater accountability among employees and managers while encouraging a culture of continuous risk awareness and responsible behavior. Internal control therefore supports organizational performance by integrating governance principles directly into operational management rather than imposing additional administrative burdens. A second characteristic of a sound control system is its ability to respond to changing internal and external risks. Business risks evolve continuously because of technological innovation, changing market conditions, regulatory developments, economic uncertainty, cybersecurity threats, and competitive pressures. Consequently, control systems must remain dynamic and adaptable rather than static or rule-based. Effective organizations regularly review and update control procedures to reflect emerging risks, changing strategic priorities, and evolving stakeholder expectations. Adaptive control systems therefore strengthen organizational resilience by ensuring that risk management remains aligned with an increasingly uncertain business environment. The program also emphasizes that sound control systems should include procedures for reporting control failings or weaknesses. Effective reporting mechanisms enable employees, managers, internal auditors, and governance committees to communicate deficiencies promptly so that corrective action can be implemented before risks materialize into significant losses or governance failures. Transparent reporting systems strengthen organizational learning, improve accountability, and facilitate continuous improvement of control processes. Whistleblowing procedures, exception reporting systems, and internal audit findings all contribute to identifying weaknesses and supporting timely management responses that enhance governance effectiveness. The effectiveness of internal control depends not only upon sound system design, but also upon the clear allocation of responsibilities for risk management and internal control throughout the organization. The framework recognizes that responsibility extends well beyond directors and auditors to encompass all organizational participants. At the highest level, the Chief Executive Officer, CEO, holds ultimate responsibility for the internal control system, ensuring that appropriate governance structures, policies, and organizational culture support effective control across all business activities. The CEO establishes executive leadership and accountability while promoting risk awareness throughout the organization. The Board of Directors provides strategic oversight by ensuring the adequacy and effectiveness of the internal control system while establishing overall corporate governance policy. The board determines the organization's risk appetite, monitors governance performance, and ensures that internal control arrangements remain appropriate to organizational strategy and stakeholder expectations. Supporting the board is the Risk Committee, whose role is to assist the board in fulfilling its risk management obligations through specialized oversight, risk evaluation, and advice regarding emerging organizational risks. Together, the board and Risk Committee establish the governance framework within which risk management and internal control operate effectively. Operational responsibility for internal control rests with executive management, which establishes internal control policies and continuously monitors their effectiveness across organizational activities. Senior managers translate governance principles into operational procedures while ensuring that control systems function effectively within their areas of responsibility. Heads of business units further develop detailed internal control procedures appropriate to their operational activities, ensuring that local risks are identified and managed appropriately while complying with corporate governance requirements. This layered management responsibility creates multiple levels of accountability that strengthen organizational control and risk management capability. Independent assurance is provided through internal auditors, whose role is to evaluate the effectiveness of internal controls and recommend improvements where weaknesses are identified. Their independent assessment strengthens governance by providing objective assurance regarding control effectiveness and risk management quality. External auditors contribute by advising management on establishing and monitoring internal controls while maintaining independent oversight of financial reporting processes. Finally, all employees have responsibility for operating established control procedures correctly and complying with organizational policies, recognizing that effective internal control depends upon individual accountability throughout the organization rather than solely upon management or audit functions.